If you took the record annual profits of Apple, General Motors, Nike, and Starbucks, and I'm not talking about the average, I'm talking about the record annual profits, you added those together, double that number, you would have approximately the annual profits of human trafficking every year.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, Migrate to Wealth listeners. Today, I have the pleasure to introduce to you a serial entrepreneur who's tried different things in his life. Some successful, it's exits, some not so successful, which is which is a journey of an entrepreneur. If everything worked out, then it won't be a journey. He's now dedicated himself to real estate investing, to investing in general. He's got a fund. He's got a lot of different things, and a man with a beautiful heart. And we'll talk about the causes he's supporting as well. I just thought all in all, we'll make an educational content, and then hopefully it'll inspire some of you in deciding what next step for you are. If anything, I'm really hoping that we'll also be able to support the cause that Paul is very close to, because that's, again, very close to my heart as well. Paul, without further ado, welcome to the show, buddy. How are you?
I'm doing great. Thanks, Saket. What an honor to be here.
No, thank you, Paul. Paul, I know in our show, we don't actually do an introduction because I want your story to serve as an introduction. But before we go there, I want to ask you one question. When you hear the term migrate to wealth, what does that mean to you?
You know, when I think about it, I think about migrating from the mindset that almost everybody seems to be born with, that if I could only have a little more or a lot more money or cars or house or whatever, I could be financially secure and I would be truly wealthy. In fact, we say, in my company, that in some of my writing, that true wealth is having assets that produce cash flow. But when I think about having a migration to wealth, it's going from that mindset to being truly wealthy. And that would be, the kind of mindset that wants to give back, that wants to love others, that wants to fulfill our calling and destiny as humans, which is to love other people and to do good in the world.
Paul, this is so true. And I think we were talking about off air that I shared this is the first time I've done that. I recently shared my personal wealth blueprint with everybody on a 4-day summit that we have, Migrate to Wealth Summit, and from October 24th to 27th. And really, it's built upon the core pillars of this topic that we're just talking about is giving is the ultimate happiness, ultimate bliss. But to give, you need access to money. And money is important. So I have given up everything and moved into a monastery living with monks. Well, that lifestyle is fine, but I would rather have the money and that freedom to do whatever I want to do. So we came back and did that. And then we started making sure incorporating your mind, your body, your relationships inside of it to give you the ultimate freedom you need. So I love that. I love that topic, Paul. Thank you again for sharing your insights. It's always interesting because it's such an open topic, migration to wealth. It's always interesting to see how my guests are interpreting that message, because you're a proxy to my listeners as well. So, Paul, what is your journey into migration to wealth? I know you've done a lot of different things. Some very successful, some were learnings. Not unsuccessful, some were learnings. And then you do what you're doing now. So give us a perspective of your journey.
Yeah, just to go back to the beginning, I started out with an engineering degree in college. That was my first mistake. And nothing against engineers, but I was not designed to be an engineer, but I didn't know myself. You know what I mean? And anyway, after that, I went to Ford Motor Company for about 5 years, had a wonderful time there, started my own company with a business partner. And 5 years later, we were able to sell it to a publicly traded firm. We each had a few $1 million in the bank, and I moved my family to the Blue Ridge Mountains. We started a nonprofit to reach out to international students studying in the U.S. And I started buying and selling real estate, started flipping houses. And it was really, really good until it wasn't. And, I found myself on the eve of 2008, exactly 10 years exactly after I had sold my company with $2.5 million in debt. And that debt was thankfully almost all, in fact, it all was against real estate. And I went through a very unique process, which I can talk about if you want to circle back to it, to end up completely debt-free 13 months later in early 2009, right in the middle of the great financial crisis. So that was an interesting win. Quickly fast forwarding from there, I ended up getting into commercial real estate, became a multifamily syndicator. And then I decided, as an investor, I want to invest with the very best to the best. And our company's not that. We're kind of new at it. And I want to invest in a diversified portfolio. And our company's not that. We only do one thing. And so we stepped back and changed our strategy and said, okay, look, we're going to go out and find the best of the best operators that we can find. There's no guarantee they'll perform well in the future, of course, but based on their team and their track record and their strategy, we think these guys and gals are going to do really well. And so we invest with them. We now have a diversified portfolio of commercial real estate, and investors invest with us, and we spread it out across these different assets and different geographies, different operators, and even different places in the capital stack. So we're on fund number 6 right now, and we're having the time of our life.
Paul, that's such an enriching story, and thank you for sharing that. I do want to go back to the part of the story where you became debt-free in 13 months. To give us a little bit more perspective before we actually go forward from there.
Yeah, so it was the fall of 2007. Things were already really bad in real estate, at least where I was, which was not too far from Washington, D.C.
And you were in Detroit at that time? Where were you?
No, we had moved to the Blue Ridge Mountains of Virginia.
That's true.
And we were near Roanoke, Virginia at that time. We were in Detroit, you're right, when we sold our company. And so I was studying a man named George Mueller. Now, for those who don't know who George Mueller is, George Mueller was an amazing philanthropist from the 1800s, and he lived pretty much the whole century of, the 19th century, the 1800s. And he had a unique strategy of raising money. He believed that God would always meet the needs of orphans and widows and people who believed that he would. So he actually prayed, and he actually was able to raise hundreds of millions of dollars in today's dollars without ever asking anybody for any money. Now, the thing was, George Mueller was also a radically strange person. I mean, he had all kinds of strange beliefs, strange by our standards. And I thought to myself one morning, what would George Mueller do if he was $2.5 million in debt? And of course, what we didn't know, Saket, is I was staring down the great financial crisis. We didn't know how bad it was going to be. And I thought, well, he would probably do something really radical, like start giving his way out of debt. And so I called my CPA and a couple close friends, and they said, well, are you going to declare bankruptcy? What are you going to do? I said, I'm going to give my way out of debt. And that went over really, really well. And I called my 4 kids together and my wife, and I said, kids, let's start giving our way out of debt. And of course, the kids were like, okay, whatever. And my wife was like, what are you talking about? Anyway, we started giving a set amount of money to some nonprofits and charities and things we really cared about January 1st of 2008. Now, we'd already been doing that, but we gave a set amount every week. And my thought was, we're either going to do this till we're bankrupt or till something changes in our finances. And it was a hard year. I mean, there was a lot of hurdles. There was a lot of difficult stuff, but 3.5 or 4 weeks after we made that commitment, I was at a Subway restaurant, and a real estate developer was there, and he gave me an idea that was like a light bulb. And I don't think it would have happened if we hadn't been giving, though I can never prove that. And I took that idea and I ran with it, and I made well over $1.5 million in the next 13 months with it. And we were completely debt-free right in the middle of the great financial crisis.
Wow, man. Are you able to share that idea?
The idea is quite complicated, and I know it sounds like I'm kind of end running you by, I'm trying to put you off by not telling you, but I'll give you the quick summary of it. We had a 5-acre waterfront tract, and our belief when we bought it was that there would be a state-maintained road run in front of it and allow us to divide it into 5 1-acre tracts. The problem was, since it wasn't on a state road, it couldn't be subdivided into 5 1-acre tracts. And I didn't tell you this part of my story, Saket, but when I made all that money as a 33-year-old in 1997, I thought, I'm a full-time investor now. I thought I was pretty cool, but I was not a full-time investor, my friend. I was a full-time speculator. I didn't know the difference between speculating and investing. I made tons of foolish decisions that partially, not completely, but partially ended us up with, $2.5 million in debt. Well, it was a speculation believing that they were going to put a publicly maintained road by there. Well, anyway, this guy in the Subway restaurant said, hey, there's this little known law you can use to potentially subdivide that into 5 tracts. And I said, well, I know all about that law. And I arrogantly said, I don't think that's going to work for me because of this and this and the other. Well, he said, well, you may want to think about it. And when he said that, bing, I had this light bulb moment. And I was like, wait, I know exactly how it could work. 2 days later, I was meeting with the County Planning and Zoning Commission using their law that prevented me from subdividing, and another law on their books that said, maybe with this really strange set of circumstances, I could subdivide. And the lady looked up at me over her glasses and she said, Mr. Moore, I've been working here for 35 years or something like that. And she said, no one has ever come to me with such an outrageous plan to go around our law. But you did, and I can't stop you, and I won't stop you. You're right. And I used that to subdivide that into 5 one-acre lots, and they were worth far, far more as 5 lots than one big piece of land. And we sold those. It took a whole lot of work, like I said, but we sold those. And I also sold a lot of other property that year, and we were completely debt-free. I even paid off my house.
Well, isn't that an amazing story? I'm glad we jumped into it. I know it was complicated, and it probably is way more complicated than you already explained to us. I think it showed a few elements there, which I want to highlight for our listeners here, is that first of all, never be that arrogant that you know everything, because nobody knows everything.
Right.
And Paul, you happen to have an open mind, and I'm glad you did. And I'm sure you're glad you did, because if you hadn't, you would have completely said, I'm not going to look at it. I've already looked at it. It's not going to work. And in our lives, we meet so many people. When we're having discussion with somebody, and I'm meeting investors all the time, they always think they know more than me, or they have an attitude towards whatever they know is the only reality. Everything else is a fiction. And I'm not saying I know everything, but whoever you interact with in the world, you're going to learn something from it. And it's your job at that point to figure out how to reflect on it. I'll quickly tell you a story that somebody told me during a framework that somebody told me recently on the summit itself, one of my mentors. And we were talking about, hey, can you tell us some good books and all that stuff? He's like, I'm actually not going to tell you good books. I'm going to tell you a framework that's going to change your entire life. And it did. Because what he's saying is when you're reading something, adopt a 4R approach. So you read, you research, you rationalize, and then you figure out if it's going to make it real for you or not. It's amazing when you start to realize the 4R. So when you start thinking about that, whatever that other person said, you're saying, maybe take it for the face value. Maybe it's true, maybe it's not. You go back and research. Maybe that person was telling you did already know everything. And then you figure out, you rationalize, does it make sense to me or not? And then you figure out how can you use the law in your favor or not in your favor, and then you can make a final decision, right? The thinking process, and unfortunately, and Paul, you grew up in the U.S., I didn't. I moved here from India back in about 23 years ago. I think what I'm seeing is, and it's probably true in India as well, nobody teaches us how to think. We're good followers. The school is giving you a framework of how to conform because they're producing assembly line workers. That's really what we are. No matter what, you're either employing your brain or you're employing your hands. So, but you're part of the assembly line. So I thank you again for sharing that story. I really loved it because it made sense to me. And it reflected a lot of things, my own assumptions that have been invalidated throughout my life, which I thought them to be so true that I could bet my paycheck on it. But then I realized that I was completely off. Right. So thank you for that.
Isn't it amazing how many things we're sure of in our 20s that we're pretty sure of in our 30s that we're not sure of in our 40s, and in our 50s and beyond, we have no idea.
Yeah, you realize that you've lived a life being completely dumb. As you start to hit your 40s and 50s, I'm in my late 40s now. I'm like, oh my God, the stuff that I thought in 20s to be true, and 30s I thought them to be even more true, and in 40s you're realizing, nope, you didn't know anything, Saket. Our life is completely different. So Paul, let's move forward from there. Now you're debt free. You haven't paid off your house at that point. So tell me one thing. People have different perspectives on debt. And being an investor right now, instead of paying the debt at least for your personal residence piece, because other debt may not have been that productive. But if you talk about just for your personal residence, why pay off the debt instead of investing that in again, considering yourself to be a professional investor, which you thought you were, what made you do that instead of becoming debt free? In lieu of becoming debt free, why not invest?
No, I agree. We had a $300,000 equity line on our house and we paid it off, but I kept it open with the thought that if I come up with the right investment opportunity, I will be ready to use up to $300,000. And we ended up, let me think. So we ended up using that actually to buy a few flip houses later in the recession, toward the end of the recession. But at the time, I was so happy to be debt-free after having such a close call that I was just glad to be done with it. You know what I mean?
No, I think I always tell people debt has two components to it. One's emotional, one's financial. And you have to understand why you're making the decision for getting out of debt. Right. Is it emotional or financial? You should never confuse one or the other. If you're making an emotional decision, I think we all have to be honest with ourselves. It was an emotional decision. Let's not rationalize it to make it financial, being a financial wonder, because sometimes it's not. Right? And there's nothing wrong. I always tell my investors that there's nothing wrong in taking an emotional decision. Just don't label it as a financially astute decision, because 10 years, 20 years, 30 years down the road, you may not feel that way. And you would think, what if? And you don't want to live in what if. What are your thoughts on that, Paul?
I just wrote that down because that is so well said, Saket. I want to remember that. You might even see that on Twitter later today.
I love that. Let's do that.
Well said. I love that. Give me your Twitter handle before we're done and we'll interact there. But no, I think that's absolutely true. When interest rates go from whatever they were on your home equity line, 4% up to 9.5%, you start thinking, hey, I really want to pay this off. I can't find any deals that make sense anyway. Pay it down if you want, but maybe consider, like you alluded to there, keeping it open so you're ready to use it at a moment's notice.
Right. So, no, completely innocent, Paul. So, Paul, let's move your journey forward now. So you became completely debt-free. What did you do next? Like, how did you become a fund manager from being a speculator? Because for those of you who don't know what a fund management is, as a fund manager, you're now investing other people's money, other investors, you're pooling group of investments together. And now you're asking people to trust your judgment in how you have evaluated a deal. Of course, they have to look at it as well, but then the fund deploys the capital. So you can't be a speculator. Hopefully you're not a speculator, because you're going to get into pretty choppy waters. You don't want to be there because of regulations and compliance and everything else. So how did you move from journey of speculation to be a truly professional investor where you now feel confident that you can handle somebody else's money as well?
Yeah. And by the way, I just want to be clear. I mean, some great companies started with speculation, right? Like Amazon and Google and a million others, Apple. But the problem is when I confused speculating and investing. Even if I started a fund that was built on speculation, like an angel fund, it might be okay. But that's not what I do. We hired a team of people. How did I get there? I should back up. So, like I said, we decided that having one syndication of one asset in one geography with one team was fine, but it might not be the very best thing. And we like the idea of having sort of like a mutual fund of private commercial real estate, but not being a REIT. We hired a handful of people, like I said, that were way, way better than me on due diligence, way more left-brained in general. It was easy for them to say no. You know, Warren Buffett said the best investors say no a lot, but the very best investors say no almost all the time. And so I hired people that say no almost all the time, and we are really loving this. We were actually not hitting home runs in the big run-up in the late teens in commercial real estate into 2021 and 22. Our goal was to hit singles and doubles. And I think we were hitting, some of those, maybe singles, doubles, maybe triples. But now that, the market's turned so quickly with the interest rate hikes, we're still hitting singles and doubles, and very happy to be doing that. We haven't changed our strategy to speak of, except we're doing one thing different. We're investing in a different place in the capital stack. We're actually investing in preferred equity rather than common equity in many cases. And that's giving us an opportunity to have a different place in the capital stack, a limited return, but a very strong return in our opinion. And again, just for my compliance people listening, there's no guarantee this will work. Right. So far, it looks pretty good.
Paul, I think you said it completely right. So I think that's where the sophistication of a fund manager, of a professional investor comes in, because you're not looking for home runs on a long-term basis. You're looking for singles and doubles, right? On a consistent basis. And if you can sustain that, compound interest being your friend, you're going to reduce the risk and you're going to give consistent returns to not only yourself, to your investors as well. So I love that strategy, because I know a lot of folks took a lot of risk in the last few years, thinking that the markets and the interest rates, nothing's going to happen to those two elements. So how they underwrote was very different. They were underwriting variable debt instead of fixed debt. And one fine day, everyone woke up to the interest rates going up. Underwrote it like 2%, 3%. Yes, they've built some caps into that, but they didn't expect it to be 8%, 9%. And that's the root awakening. So if you're actually changing your underwriting style, depending upon what the markets are there, you may not be successful on a long-term basis. But in your case, Paul, as you're suggesting, is that you are still using the same underwriting techniques. You just change where you invest in the stack, which is fine. Just understandable. You see the right opportunities there, and you're further lowering the risk. Completely understandable.
Right.
So what is your underwriting right now? What is your go-to strategy that you've been following for the last several years in terms of debt, in terms of how you underwrite the deals? And I know you are not the left brain guy, but I'm pretty sure you understand at a conceptual level, what are some of those underwriting things that you try to adhere to and that you believe have helped you stay afloat? Mm-hmm. Because a lot of the syndicators are going up right now.
Yeah. Before I jump into that, I'll make one comment. I wrote a book about multifamily investing in 2016 called The Perfect Investment, and a little humble title there. And then I went on hundreds of podcasts and did lots of blogs over the next 7 years and said, it's not really perfect after all if you have to overpay or over leverage or use dangerous debt. And what I didn't realize, Kit, I did not realize the potential impact of rate cap reserves. Now, for those listening, you might have thought I meant cap rate. No, rate cap. And you mentioned it a moment ago, there's a rate cap you can buy if you have floating rate debt. Let's say you got in a debt at 3%. Well, you can buy a cap saying, hey, if it goes over 5, that cap is activated and it keeps my rate at effectively at 5%. What I didn't realize at the time was those rate caps, because we didn't have rate caps. We didn't deal in these type of debts, these debt ourselves. So I didn't realize that those caps expire. And when those caps expire, let's say a year before they expire, the lender can mandate that you set aside money to buy the new cap, because they can underwrite and see what would happen if you did have to go from 5 to, let's say, 8.5%. And so they can make you set aside money. I have a friend who was setting aside $1,000 a month toward his future rate cap, and the lender came in and said, okay, no more. It's going to be more than $1,000 a month. It's going to be $89,000 a month. And I said, wait a minute, you're kidding, right?
From $1,000 to $89,000 a month.
Yes. And I verified that was the number. And so the point is, how are these guys surviving? I mean, I get that they've stopped distributions, but it feels worse than that to me. And I mean, obviously that's a very, very big deal. It's not a little, it's not a 150 unit apartment, but you get the point. It's very painful. So what we've been diligencing, the type of debt, the LTV, LTC, of course, the debt service coverage ratio, but we're also, checking out, how organized is the team? How long have they been together working out of the same office? How many years experience do they have in this asset class? How do they pick their property manager? How do they do property management? How do they talk about their employees, their investors, their spouse? How do they speak to the waiter or waitress at the restaurant? All these different things. We're doing very detailed criminal checks, background checks. We even do background checks if they have, let's say, a lender, a small lender. Let's say they got a hard money loan on the side, or a small loan for some of their portfolio. And that might not make sense, but let's say in a mobile home park, you might have a loan on the park, but also a chattel loan on the trailers themselves or the mobile homes themselves. Well, we do background check on them too. We do an NOI audit. That's a net operating income audit with a third party where they thoroughly audit to see, is this really true? Is the money flowing like they say it does? And so even with all that, there's the number one risk that we all have. Your investors, my investors, we all have the same risk. I shouldn't say yours, and that is that somebody in the organization you invest with will commit fraud.
Mm-hmm.
That is a wild card that is really hard to protect against. But think about it. These assets, they work. The reason that they wouldn't work is if you over leverage them or unsafely leverage them, or if there was fraud. There's probably another dozen reasons, but fraud is the big risk.
Yeah, I think it's important, right? So I think we, like any other risk, because we deal with that on a day-by-day basis when we're evaluating for myself even, you can only minimize the fraud. You can't zero out the fraud risk, right? Because you don't know when somebody wakes up. You can do all the perfect background checks on anybody. Somebody wakes up tomorrow morning and decides to do something that they have never done in their life. Right. It could be triggered by motivation. It could be triggered by some chemical change in their body. You never know, right? So I think the only thing you can do is put checks and balances. Like we always have checks and balances that if something were to happen, we can catch hold of that ASAP before a major damage is done. That's the only thing you can try and plan for. But to say that, like I remember my first deal, Paul, I'm sure you did too. So you may have similar experiences. An investor said that, and I think she was going to invest like $50K. The raise was about $8 million raise. And this person said, what if you run away with my money to India? I'm like, let's think, it's a valid point. I could, but let's also think about, I was with Fortune 500 companies for the last 20 years, including Airbnb for 5 years. If I'm going to run away, probably not going to happen for $8 million. So we have to start putting things in perspective that you have to, yes, it may happen. But you start thinking about the probabilities and how are we putting checks and balances in the case, right? Because we had other partners in the deal who have access to financial, and we're sharing financials with you. And you have the ability to get the financials audited at your cost, of course. But if you really, and first of all, the other thing was, if you're coming to me with a perspective that I may fool you, that I may be a scammer, do you really want to invest your money with me? I can try to convince you any which way at this point. That conversation is great to have, but if you don't trust me, you don't trust me. And if you don't trust me, right, you should not invest with me. Or let's develop this trust to a point where you feel comfortable, right? So to your point, Paul, I really love that idea because very few people talk about fraud as one of the things that you want to underwrite for. To a certain degree, you can fully eliminate that, and that risk is going to happen. Now, that risk is also available when you're investing in public equities, right? Enron, right. Great example, right? So nobody could really prevent fraud. You can just hope that people that you've done your background checks and everything else, that stays in checks and balances. So thank you for bringing that up, Paul. I really love that. And I love all that you have said. So Paul, in terms of I know you wrote the book, Perfect Investment, but I know since that you've diversified beyond just multifamily. Tell us the asset classes that are of interest to you right now.
Yeah, we really love RV parks. We were interested in investing in that for a long time, but we couldn't find an operator we knew, like, and trusted for years. But we've added RV parks to the portfolio now. We have found that operator. Self-storage, mobile home parks, light industrial. Believe it or not, a lot of the industrial parks you see out there are mom and pop owned, and they've fallen into decline over 20, 30, 40 years, and they're a perfect value add candidate, just like multifamily in many cases. We also invest in open air shopping centers. This would be like, for example, a Walmart or Kroger or Target anchored strip center, the higher end strip centers. And we also invest in tax advantaged multifamily. And what I mean by that is, in certain states like New Jersey and Texas, the property taxes are an enormous hit to the balance sheet to the income statement and the value. Well, if you can invest in assets that have the property taxes 80% or even 100% removed for the next 99 years, it can really impact the value. And we've invested in quite a few assets like that.
Awesome, Paul. Paul, and most of your funds, I know I believe I can't remember, you mentioned on air or off air, you're on your 6th fund right now? You've closed out 5?
Yeah, we're on our 6th fund. We've done 5 income funds, 1 growth fund years ago. And we're loving life right now. We really enjoy what we do. We enjoy the opportunity to give investors diversification and the fact that we're hopefully picking operators and deals that are going to have a nice high margin of safety in times like this.
Love that, Paul. Paul, I do want to end towards the end of the show. I want to bring it back to what we started with, that if you're not impacting lives, you're not doing anything, right? All of this is of no meaning to anybody. So I know you have a very special cause that you guys support. Can you talk about that a little bit?
Saket, I was shocked to find out. I did the math myself. If you took the record annual profits of Apple, General Motors, Nike, and Starbucks, and I'm not talking about the average, I'm talking about the record annual profits, you added those together, double that number, you would have approximately the annual profits of human trafficking every year. It's shocking, and I had no idea. But when I looked into it, I found out it was much worse than that, much worse than I'm willing to tell you about on the air here. I can tell you I've had 2 family members just peripherally affected by this, and I've seen the devastation it caused in their lives over decades. And I just didn't know what to do about it. Was I going to go on a commando raid to Bolivia or Cambodia? Probably not. Was I going to send money off to somebody I didn't know, really? I didn't like that idea either, though that seemed a little more palatable to me. What we decided was we wanted to do the same type of due diligence on a nonprofit that we did on commercial real estate. So we looked at a few of these, looked at several actually, and we landed on one we really liked. And so we've raised, influenced, and donated a lot of money to these folks over the last 3 years. It's called AIM, AIM, and the website's aimfree.org. And AIM does an amazing job rescuing little children, girls usually, in Cambodia and Belize. They give them a new life, a safe home, clothes, food, shelter, counseling, job skills, and put them on an amazing path to have a chance for a great life. And so we're donating to them. For $1,000, you can actually rescue a child. Now, the cost to get them healthy after that's much, much higher. But for $1,000 each, you can rescue a child. And so we're raising money. We're asking people to join us on Giving Tuesday, but they don't need to join us. They can go straight to aimfree.org. Or maybe find another organization that's doing a great job in this arena.
Paul, so thank you. I think these are the things that really matter, right? Because after a while, no matter how much money we all have, it's not going to impact our lives by drastic. What the study says, after $75,000 of your income, you can buy a private jet, you can buy whatever you want to buy, but it's really not a material difference in your lifestyle, right? But for $1,000,
isn't that amazing?
This person, this individual, this child, and I've heard stories about sex trafficking starting as early as 3 years old, right? I mean, I have daughters.
Horrible.
And it's just, I have 2 daughters, 8 and 10. I can't imagine somebody going through that and they have to go through that. It's heartbreaking. So thank you again for supporting this cause, Paul. And of course, anything we can do, we'll put up the message.
Yeah.
I think we'll send out an email to our list as well. Because this is something, especially in this day and age, this is not an acceptable human behavior. And unfortunately, it's because these kids are getting trafficked because somebody's paying for it, right? Now, we may not be able to stop that aspect of it because they have to look deep inside of themselves of what they're doing, and that's upon them. They have to live with it. They have to carry that baggage with themselves. What we can say is we can try and help kids who are already in that racket, try and extract them.
Yeah.
Right. So thank you again, Paul. I really appreciate that.
Thank you. I really appreciate you giving me a chance to talk about it. I'm saying there's an organization called Exodus Cry who actually told us they do a lot of research and prevention. They said that one country, I think it was Sweden, turned it into a felony to buy a prostitute, and the amount of trafficking in that area just plummeted and went to almost zero from what I understand.
Yeah.
So there's one thing governments can do.
They can definitely do. And hopefully at some point, most governments will awaken to that, because that's something that shouldn't be any society, given where we are. Paul, with that note, man, thank you again for coming on our show. Where can people connect with you?
They can follow me on Twitter at Paul Moore Invest, or they can come to our website to get free special reports on RV park investing and more at Wellings Capital. That's WELLINGS, wellingscapital.com/resources. resources.
Awesome. Well, Paul, we'll make sure that all these resources get included. I appreciate that. And for all my listeners, if you stuck with us till this part, that means something in that episode caught you and you wanted to listen to the end. I appreciate that. We will not be able to do this show without your support, without you tuning into the show. And hopefully we're impacting lives as we speak by sharing stories and by sharing the approaches that someone like a Paul. Appreciate it. Thank you, Paul.
Thank you, Saket. It was a real honor to be here.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Saket on an investor call. That link is waiting for you in the show notes below.